Welcome back. Today's episode is a discussion on how do tax deeds work in Florida. To start with, Florida handles their tax defaulted property auctions a little differently than some of the other states. The state of Florida starts the default of a tax property with a different process, and it's called a tax lien certificate auction. So, what are they doing? Well, the defaulted property owner will have a lien placed against the property. And what does that mean? Well, that just means that property's in default. All right, so I'm Ted Thomas, and I've been involved in this process for well over 30 years. And here's what I've found out. There's a ton of confusion. So let's see if we can really simplify this. The rules of the auction process are mandated by the state, and each state can have their own rules. So the responsibility for governing the state always comes down to the legislature making the rules. Then they pass the rules down to the Board of Supervisors at the county or the county commissioners, and then they tell the treasurer what to do. So notice I said each of the states can have their own rules. So Florida is a little unique. So investors can find all the rules in the statute books, on the county websites, or you certainly can find them on the state website. So the first reading of the statutes is going to impress you. How's it going to impress you? You're going to realize that it's complex and it's rigid, and everybody kind of has to follow the rules. So that means I'm not in the business of being an attorney. I don't give tax advice, and I'm not giving legal advice. I'm an author, and I'm a publisher, and I'm an investor. I'm just going to try to make this as simple as I can. All right, so let's learn about Florida. All right, so as I say, the legislature makes the rules. They pass it down to the county, and every county in every state, all 3,000 of them, the property owner must pay property tax. Now, if they don't pay the property tax, well, guess what? There's going to be some consequence. So we're going to talk a little bit about what the consequences is. So the treasurer will have forced the issue and said, look, if you don't pay your taxes, we're going to confiscate your property, or we're going to issue a tax lien certificate. Now, Florida is a benevolent state, in my opinion. Now, why do I say that? Because Florida, they allow the property owner, even though they're in default, to stay on the property. So the official county treasurer has completed a default notice, and now they've set up a tax lien certificate. Now, what does this tax lien certificate say? It simply says that anybody can come in and buy it, so they announce it. Instead of you going into the county, they're going to have a county auction, which would be online, be published in the newspaper, could be online or offline. All right, so in all 67 counties, Florida will place the properties on a tax defaulted list, and those are called tax lien certificates. Anybody can buy them. Simultaneously with the county doing that, they will have issued notice to the property owner. So the property owner is staying on the property. They're not moving the property owner off the property. The tax certificate is posted. It means that's announced on the county website and also in the local newspaper. Anybody can go in and pay the taxes on this property. So in this episode, I'm answering the question, how do tax deeds work in Florida? So I'll come right back. All right, now we're trying to answer the question, how do tax deeds work in Florida? Well, it starts out with a tax lien certificate. That's where the whole process starts. So first they sell the tax lien certificates. Anyone can buy those. Their starting bid is the actual amount of the certificate. So you have to pay 100% of that. So you're bidding up and down on the interest rate. So let's say Florida's highest rate is earned on that certificate of 18%. That means all the counties can sell certificates and pay up to 18%. Other states might be a little higher, or they might be a little bit lower. Okay, so the tax certificate sold in Florida gives the homeowner 2 years to pay. All right, so that homeowner can go 2 years, but then they finally have to come in and redeem the certificate. That means they have to pay for that certificate. And if they have to pay 100% plus that high rate of interest, which was 18%. Now, these are outrageous interest rates, but that's what they want. So the property owner must come in and pay the certificate, pay the 18% for each year, and then they get their certificate back and they don't lose their property. All right, now if they do lose their property, okay, if they have not come forward and they have not paid, the owner that bought that certificate doesn't automatically get the property. In many of the other states, the owner automatically gets the property, although they do have to go through a foreclosure process. No, the owner of the tax lien certificate in Florida, after 2 years, now has to petition the county. They must petition, or they must request the county to have another auction. Now, the second auction is called a tax defaulted auction. That means they're actually going to sell the actual property. Now, the certificate owner still has the certificate. Property owner still owes them 2 years of interest plus whatever they put up. But now the property is going to be sold at a tax deed auction. So what are we covering today? How do tax deeds work in Florida? It's a second auction. Now, at the second auction, anybody can bid. It doesn't necessarily mean that the tax lien certificate person will get the property. They might not get the property. Anybody could get the property. So the point is, 2 years went by. You hold your certificate for 2 years if you own the tax certificate. So you're worried, when are you going to get paid? Well, you're going to get paid when someone else comes in to buy it. When they come in to buy it, they'll pay more money than the certificate was, and they'll not only be able to pay their tax certificate, but they'll be able to pay that 18% interest. So think about you if you bought a tax certificate. You're doing fine, getting 100% of your money back, plus 18 and 18, plus 36%. So the property's been re-announced for auction. It can be sold to anybody that wants to buy it. So the difference in Florida is the tax deed auction doesn't happen automatically. The tax deed auction is going to happen at the request of the tax lien certificate buyer. So the tax lien certificate holder must request the county have another auction. The county then will sell it to the highest bidder. How do you get paid? When the highest bidder pays, they're going to pay more than you paid. And if you're on the tax lien certificate, you'll get your full payment and you'll get your 18% for each year. So the brief answer is, they're not going to lose their money, so that's a pretty good deal. So the original owner will now get 100%, original owner of the tax certificate will get all their money plus the 2 years. All right, now the new owner will now get a deed to the property. When they get the deed to the property, we're answering the question, how do tax deeds work in Florida? When they get the deed, they will get the deed without any mortgage and without any deed of trust loan. So it'll be clear of loans. Now, could there be HOA loans? Yes, if they haven't been given notice. Could there be RS liens? Yes, if they haven't been given notice. But if they're given notice, those liens will actually drop off the property. So the original bidder of the tax lien certificate got their money back, plus 18% for each year, so they're going to be very happy campers. All right, it's a second auction. It's not the absolute first auction. So the first owner got paid. Now the second owner can do whatever they want with their property. They can sell it to whoever they want. They can sell it at whatever amount. They can hold the property. They can build on it. They can move into it. They can do whatever they want. So properties that are at these auctions sometimes don't sell at all. All right, so that's another whole challenge. What's going to happen with those tax deeds? Well, if they didn't sell as a tax lien, the county will try and sell it again. The next auction that doesn't sell, they'll try it again. Finally, they'll put it on a surplus lands or leftover lands list, and they can be purchased there for the face value of whatever that deed is. So properties are sold over the counter in Florida after both these auctions take place. Now, the physical condition of the property is always the buyer's responsibility. All right, so when you get the property, you're going to get a deed to the property. When you get that deed, before you bought that deed, you need to make sure that you've had boots on the ground and checked that property out. So if you're buying tax deeds in Florida, you're getting a property. That means what you should do is you have boots on the ground and check that property before you purchase it. Why? What if there was a hurricane? What if there was a fire? What if it was next to a chicken farm? You need to know those things before you buy. All right, if you don't know those things, don't buy the property. All right, second thing you need to know, if you're buying actual property, you're buying tax deeds, then what are you going to do with that property? I suggest you always have an exit strategy before you buy. Do not buy the property and then hope you're going to sell it. In other words, go and look at it, figure out what the comparable values are, figure out what you're going to sell it for, and now you'll know what price you'll pay at the auction. I'm Ted Thomas. I'll see you in the next video.